NBFCs. Citi in their overnight note has upgraded NBFCs. Some of them have moved really strongly. And Parag bhai, I wonder if you are constructive on NBFCs at the current juncture.
Yes, Neeraj. As you know, we had already discussed Bajaj Finance at around 6,800 some time ago. Then we discussed Piramal at around 840, 850. And now, basically, I have been very constructive on this sector because there are structural tailwinds for the sector emerging now. Cost of funds will peak out very shortly, in my view. As we move into April and the liquidity available in the market and with RBI reducing repo rates, the cost of funds for the sector will go down. Credit cost, what I am hearing on the ground is that after government has started spending from December, a lot of the pain in the loan book is now getting addressed, and at least the asset quality on the unsecured side is also not worsening. So this is a great news for NBFCs that the cost of fund and credit cost both are likely to peak out and now reduce from next year. And typically for a NBFC, which I am going to talk about today, which is there in my portfolio with a disclaimer that investors should buy with 1 or 2 year view only, which I am going to talk about is Aditya Birla Capital. Of course, it's a Kumar Bangla Birla run company, so promoter is great. Most importantly, the CEO, after she has come, Mrs. Vishakha Mule, has done a wonderful job in terms of calibrating risk whenever it was required. For example, whatever digital or unsecured loan was there, they ran it down from 20,000 crore to 15,000 crore. And now they are sitting very comfortable. I think ROAs have bottomed out in Q3 at 2.1%. ROAs can only inch up. So if I just summarize, 45,000 crore is the market cap of the company. 20,000 crore is the value of their stakes in, say, Birla Mutual Fund or Birla Life Insurance, Birla Health Insurance. So the lending business itself is available at only 25,000 crore, and that is sustainably going to make 3,000 crore PAT. And this 3,000 crore PAT will grow at 25% according to their guidance. So in my view, it is a 8 to 10 PE stock with 25% growth potential with all the structural tailwinds in place. So I would say that's a very, very good long-term buy and great management and absolutely great CEO and the team.
It's interesting, Parag bhai, Harsh also joining in, that on the same day that you've come out and spoken about this one, we have a Macquarie note as well, which talks about AB Capital. They've maintained their outperform. 59% upside is what they see from here. Largely 260 being the target price. One of their top picks, on track to double in the next 3 years. The book size, recent underperformance offers good opportunity, they say. Key catalysts, rising margins, falling rates, growth in higher yielding unsecured, and falling credit costs leading to higher ROAs. And valuations also a big support, all of which you have spoken about, Mr. Thakkar. But also want to understand from you, do you believe that the unsecured and microfinance cycle, in terms of asset quality, are the concerns behind us? Because one thing is margins, the other piece is the other engine which really needs to start to improve is the asset quality engine. Do you believe that the worst is behind us and probably Q4 will be the worst quarter?
So I'll tell you, AB Capital does not have an exposure to microfinance.
Correct.
That is the reason why I have bought that in my portfolio.
Right.
And that entire credit goes to, again, Mrs. Vishakha Mule, who is the CEO, who took that decision because that was very juicy segment to lend, right? Because you earn very high interest rates there. And so margins and ROA look very good optically, but afterwards there's a pain. So I would say that up till now, I have not ventured into any microfinance company. I would like to stay with, as I told you before, Bajaj Finance, then Piramal, and which has a 1,200 crore exposure to microfinance only out of the 70,000 crore book. And AB Capital does not have exposure to microfinance at all. So I would not like to venture into microfinance, although things might be turning there also. And as you rightly said, in Q4 it might peak out. But I would like to stick to these lenders which are well established, well entrenched and who have taken a very calculated risk. See, in leverage business, you have to take risk. But who have taken a calculated risk, who have calibrated the risk by reducing, I would say, the loan book size to, say, unsecured loans. And now they are in fantastic shape. And as I said, cost of funds have peaked out. And credit costs have also seems to be peaking out, because from December, you have started seeing that credit asset quality is not worsening, at least in the segments where AB Capital or Bajaj Finance or Piramal kind of guys are lending. And another one aspect which I would like to add, that I explained to you on PE basis, that is 8 to 10 PE for a lending business, which is going to grow 25%. At the same time, price to book wise also, the lending piece is available at below book value, 0.8 times, while the sustainable ROA is about 2.2, 2.3%. In Q3, it was 2.1, which was the bottom. So I would say that next year ROA is definitely going to improve, because, as I said, cost of fund is going to come down, which will improve margins. Credit cost is stabilizing or looking better. And third one is that their housing finance book, their book is 26,000 crore, but they have incurred all the expenses for 50,000 crore lending book. So there again, the profitability, there is operating leverage there.